Do you agree with the Fed that we are sufficiently restrictive?
I think so. I mean, if you look at any metric like Taylor rule and things like that, I think things are restrictive. I think another thing to kind of remember that the inversion of the curve itself ends up being restrictive from a credit creation perspective. That is, if your funding cost is 5.5% and you can lend out at 4.5%, the likelihood that the banking sector will probably go out and create a lot of credit, a long-term credit, is not possible. So I think it's restrictive. It's, could it be more restrictive? Yes. But if it is a lot more restrictive, then the risk of a recession becomes significantly higher. And that's what kind of worries the Fed far more than whether inflation can persist for another 6 months or not.
Can we build on that just a little bit more, the importance of the banking channel? Because if we were sat here last spring, we would have said what's about to happen is going to send this economy into recession. Bob Michael, good friend of ours, yours too, sat in your chair just last week, and he talked about the importance of credit markets, private credit, really picking up things off the back of a banking sector that maybe struggles just a little bit, given the forces you've just described. How important is the bank lending channel to the broader economy?
Well, so I think the private credit market is important for the financial economy far more than the real economy. That would be my sense. I think if the banking channel is still very important. The size of assets in the banking sector as opposed to private credit, I mean, these are orders of magnitude different. So yes, private credit certainly helps with respect to valuations and financial assets because of financing costs and things like that. But at the end of the day, what happens in the real estate market, what happens in SME sectors, it's really driven far more by banking. I think irrespective of how large the private credit market gets, the impact of that in the overall economy is still going to be relatively small for some time.
I'll try and read Lisa's mind then. So is the Senior Loan Officer Opinion Survey still relevant?
Absolutely. And I think the Fed pays a lot of attention to that. I think that's their benchmark about how people are feeling and what's the direction of credit creation in the market.
Although that's the reason why people have been basically paying attention to this, but why we have not seen the kind of weakness that we would expect to see, because so many people do not any longer rely on that bank lending in the same kind of way. I wonder, do you think that this market has fully adapted to rates where they are? And I understand the mortgage market is separate, but aside from that corporate America has largely adjusted to rates.
Well, so let's talk about two different issues. One is, did the rate sensitivity of U.S. economy go down because of sustained low level of rates for an extended period of time? Absolutely. And therefore, the rate sensitivity today is going to be meaningfully lower than what it was in 90s or early 2000s and those time periods. But having said that, though, I think at this level of rates and an inverted curve, saying that there's no impact of high level of rates in the market, including mortgages, I think it's not as large, but it is still a driver of investment decisions and things like that. If there wasn't enough stimulus, so if we kind of analytically, if you analyze it, you have to kind of strip out what the impact of stimulus and the fiscal policy really has been on growth. And if you do that, I think you'll find rate sensitivity lower, but it's still significant.